Welcome to Conversations with Claris. Today our topic is defining wealth management. And I'm joined here today with Scott Iverson from Claris. So Scott, we hear a lot about wealth management and financial advisor, investment advisor. We hear all kinds of terms, but wealth management seems to be one that sticks in everybody's head a lot. So give us your take on what wealth management really is.
Thank you, Stan. If I would, I'd like to start by kind of saying what it is not. When I think of wealth management, you hear a lot of different terms thrown out there, as you mentioned, and what it is not may be just as important as what it is. So let's eliminate some of those things first. And I would say things like meme stocks, esoteric investments, chasing returns, trying to predict what the market's going to do, what the economy will do. That is not wealth management. In my mind, that is something that is akin to speculation. And if one is in a casino, or even if they're doing it in a quote-unquote investment account, that's okay. It's important to call it what it is. So that's what wealth management is not. A real quick note on that. We have met with a lot of people and talked with a lot of people who believe that because they have a little bit of, maybe not a little bit in some cases, a lot of money, that some of these rules that we're going to talk about don't really apply to them, that there's a different route around this for them. And in a lot of places in life, that is the case, that money can get you access. The evidence here is overwhelming, though, in that money doesn't necessarily buy you access to these magic investments, that the evidence is the evidence, and it shows that there are certain time-tested principles that really work.
AKA hedge funds, right?
Yeah.
We hear a lot about hedge funds and how the people with the money can get access to that. And the evidence, as you said, is clear. Hedge funds, when you look at them, really don't fare well.
That's exactly right.
So yeah, to your point.
Yeah, and it's because they end up, in a lot of cases, doing the things we just said wealth management is not.
Right.
So to shift to what it is, wealth management is about finding goals, determining goals, sitting down with our clients, talking through the trade-offs that come with wealth. Is college planning the most important thing? Is retirement? Is travel? Is leisure? Is helping a family member out? Is that the goal? Usually there are multiple goals, and we help those clients determine what the most important goals are, and then work to achieve those goals as best we can. Once we've determined those goals, really the 30,000-foot view, we get into financial planning, and that's the roadmap that we develop by taking those goals, figuring out where we are, which is relatively easy to do, figuring out where we would like to be, and then building the plan to get us from point A to point B. Underpinning all of this is really the most advanced, sophisticated probability analysis software out there, which we use to help not only get the road to where we're going, but make it the best road. So we're not traveling along a terrible road with a bunch of potholes and muddy and rutted, but a nice highway that gets us where we want to be. That financial planning, once that is complete, then it's time to really get into more action of the portfolio implementation. And in that regard, we rely heavily on evidence to build out an evidence-based portfolio, following the financial planning, which was set in place by the goals. Once the portfolio is in place, there are really, in my mind, two more things that are very important for a wealth manager to do. The first is rebalancing. And we saw this in stark detail last year. When markets really drop, odds are portfolios are out of balance. It's the perfect opportunity to buy low, which everybody talks about, but people tend not to do, as you know very well. Rebalancing forces us to do this. And if we follow an evidence-based method of doing it, it's not speculation that leads us to do it. It is simply math. And over the long run, A strategy like that ensures that we are consistently buying low and selling high. The last aspect of what I would consider sound wealth management would be the tax management aspect of a portfolio. And there are three components of that. The first is tax loss harvesting, which is when the market does drop, which we know it will sometimes. We also know we can't predict it. So when that time comes, we want to grab those paper losses so our clients can use those to offset capital gains that we are confident will come if they haven't yet. The second part is to avoid some dividends and capital gains that can be paid out by some of the investments. And we don't always have the opportunity to do that, but when we do, we want to make sure that we grab those. Grab the losses, avoid the capital gains. And then lastly would be to use very tax efficient investments, either ETFs or mutual funds. And the way we do that is we use the world leaders in implementing investment strategies that are very, very tax sensitive. So in my mind, that is what would encompass the word wealth management.
Great, Scott. Hey, we appreciate you spending some time with us. We appreciate your insights on what wealth management is, what we think it is here at Claris.
Thank you.
So thanks for joining us. Our next topic will be the value of an advisor. We'll be talking a little bit, what is the value of a true financial advisor? So in the meantime, if you have any questions or you have topics that you'd like to know a little bit more about, please send them on to us, and we will put those in our back pocket, and we'll try to answer them when we can. So again, thanks for joining us.